Good morning, everyone. My name is Will Fett, and I'm the outreach coordinator for USDA Natural Resources Conservation Service. I'm also happy to be the point of contact for beginning farmer ranchers for Oregon, along with an incredible team that can help answer questions from the different agencies. The Beginning Farmer Rancher program is a coordinated effort between Natural Resources Conservation Service, the Farm Service Agency, USDA Rural Development, as well as Risk Management Agency. So happy to have you all join us here today. We're going to focus today's session on livestock producers, but many of the programs that we're going to touch on and address today do have applicability to producers of all varieties. So if you hear something from today's presentation and wondering if it does apply to you, please ask that question, and hopefully we can get all of your inquiries answered. We are recording this session and we'll post it to YouTube afterwards. And then, as I mentioned, we will be going into breakout rooms at the end of the session so that if you have any specific questions to your production operation, you can ask those directly of the agency representatives. So I'm going to go ahead and dive in and get started. And just a little bit of background about the Beginning Farmer Rancher program. It is targeted towards beginning farmers who have 10 years of experience or less. So we are really looking at how can we build a new generation of farmers. That doesn't mean they are all fresh out of college. In fact, many beginning farmers have experience in other industries and come to farming later in life, but are just starting that operation. So beginning farmer ranchers have 10 years of experience or less, and each of the agencies does have a slightly different definition of who qualifies for beginning farmer rancher. So, but in general, we're looking at those individuals who have owned or operated a farm for fewer than 10 years. Beginning farmers and ranchers fall into a category what we term historically underserved, and there's other categories of historically underserved, such as socially disadvantaged. But what we're really trying to do is make sure that all USDA programs are available and accessible to farmers of all levels, of all backgrounds, so that we can make sure that programs are delivered equitably and fairly. Veterans also fall into that group of historically underserved, and similarly to beginning farmer ranchers, veterans are those who have been out of the military for no longer than 10 years. To get started with USDA programs, a lot of times the best place is to connect with your local USDA service center. There is a local USDA service center in almost every county across the United States, including in your local county. Sometimes multiple counties are served by one center, but in most cases, it's the service centers are located in each county. Quite often, the Farm Service Agency and the Natural Resources Conservation Service are housed together in the same facility. And then our partners with Risk Management Agency and Rural Development are either statewide or regionally based. But there is still someone who is available to answer your questions and help you with specific programs. So for today's session, sorry, I didn't update this slide. We're going to talk through those different agencies, and then and then you'll have a chance to go into breakout rooms for question and answers. The Natural Resources Conservation Service does provide technical assistance to producers and financial assistance. So a lot of times that starts with a visit to the farm to identify what resources you as a producer might be concerned about and offer some technical advice. But we know that technical advice isn't necessarily good enough if you don't have the financial resources to be able to do something about addressing those resource concerns. So there are financial assistance programs through NRCS that help implement good conservation practices on your property. those conservation practices that might be specific to livestock producers, there are a lot of different opportunities here, but I've listed the top 5 that are applicable to beginning farmers or widely used by beginning farmers that are raising livestock. One of the first ones is brush management. We do have fencing help, creating watering facilities, prescribed grazing plans, and livestock pipelines. What is brush management? What we're talking about is trying to create a very highly desirable plant community, restoring vegetation, enhancing fish and wildlife habitat, improving forage quality. By removing some species, you can enhance the production of other species. And then, of course, we're also talking about removing noxious weeds or other invasives that are undesirable within the plant community. Fencing is a big piece of the livestock puzzle, and ultimately it's pretty simple. You're creating barriers to animals. That keeps them on certain pastures or out of other pastures. And a lot of times what we're focused on is keeping the animals away from streams or other places that can be highly eroded, and making sure that they do have good access to watering facilities elsewhere on the property. So fencing is an important piece of managing livestock. With that, if we're removing the cattle from a stream or other water source, we do want to make sure that there's a watering facility. So a lot of times these conservation practices can be used together jointly, and providing a supply of water to livestock so that they don't have access to an erodible stream is going to be important for ensuring the health of those animals. Good watering facilities also can move animals around a pasture if you have multiple watering facilities around. And like I said, it's that alternative watering source to something like a natural river or stream. Prescribed grazing plans are very, very popular with livestock producers. And what this enables us to do is maximize the available forage, maximize the forage quality. And a lot of times what we're doing is putting animals in a smaller confined area so that they can fully utilize that plant community that's present. With good pasture rotation, moving those animals around the 2 different pastures, you're ensuring that no one area on the property is getting overutilized, and making sure that you are taking advantage of all the property that's available to you. This helps actually increase species diversification and composition and quality. This increases the water quality because you're helping those perennial plants put good roots down into the soil and prevent erosion. So prescribed grazing plans are an important part of managing livestock. And then similarly to providing water, having the livestock pipeline will move water from one location on the property to another location. What we're looking at here is moving water, but also reducing the energy use for moving that water. So part of conserving natural resources is making sure that we're using energy efficiently. So those are just a couple of examples of what livestock producers can do, but really every solution can be tailored to you, and that starts with creating a plan. Visit your NRCS district conservationist, have them come out to the property, have them talk about your goals and what you want to do, and then you can build a plan together and then implement that plan. It is an application process. There are eligibility components that figure into it. Unfortunately, we can't fund everyone, but with the Inflation Reduction Act, we are able to really financially assist a lot of producers, and are able to award many contracts through this process. And we're with you every step of the way. So from that planning process all the way through implementation, it's potentially it's at least 1 year process, but probably multiple years, and we're with you every step of the way. There are some deadlines associated with our programs. For the Environmental Quality Incentives Program, that deadline is typically in November. So there's plenty of time now to start the conversation, put in an application for November, and then plan for the 2025 year. Another program that we have, the Conservation Stewardship Program, CSP, that application is typically due in March. So it's a really good idea to sign up for email news alerts to make sure that you get all the up-to-date information and have those deadlines hit your inbox. But it's also a good idea to go ahead and start that conversation now. We do provide benefits to historically underserved producers, and those come in the form of higher payment rates, the opportunity for advance payments. Most of our contracts are worked on a reimbursement scenario, but historically underserved have the opportunity for advance payments. And then we have funding pools, which gives you the opportunity for priority in consideration as a beginning farmer or as a socially disadvantaged or as a military veteran. When we talk about what does this financial assistance look like, we roughly estimate that 70 to 85% of the costs will be covered by contract. It's dependent on the specific conservation practice that you choose. And in some cases, those can actually be 90% or even potentially 100% of the cost of implementation. So it's important to do an estimate with your conservation planner and get a good understanding of how much would be covered. But we can usually say it's at least 70%, potentially up to 100% of the cost of implementation. We're looking at approximately a 1 to 3 year timeline, and there's that technical assistance that's available throughout. So happy to answer questions when we get into the breakout, or if you want to go ahead and drop those into the chat. We might have a little bit of time at the end. And unfortunately, our Farm Service Agency representative, Derek Johnson, is not able to join us today. So I'm going to briefly highlight some things that are available through Farm Service Agency. And when we get to the breakout session, if you want to join me in my breakout session, I will try to answer Farm Service Agency questions as best as possible. So Farm Service Agency has farm programs as well as loan programs. No matter what you're interested in, when you start that first visit, it's always a good idea to bring proof of identity, a copy of the record or deed of the property that you are that you have, and exactly what status your entity is. If you're a sole proprietor, or if you're incorporated, or if you are an estate or a trust, having those legal documentations helps the process go a lot more smoothly. FSA, if your farm isn't already enrolled in FSA with a farm number or a track number, they will enter your farm into the database so that you can be accessed, and it plugs you into mapping scenarios. It gives you a farm serial number, or a farm number is what you've likely heard about before, and helps facilitate the application process across multiple USDA agencies, including NRCS. So you have to be registered with the Farm Service Agency before you can apply for NRCS programs, and we partner very closely together on that. Farm programs include crop acreage reporting, disaster programs. We have a lot of wildfires in the state right now, unfortunately, and many of those producers on those lands that are experiencing wildfires could apply for some of the disaster programs. So it's always a good idea to know what farm programs are available and if you might qualify for those. Another one that is somewhat new, but is getting a lot of traction, is the Farm Storage and Facility Loan Program. It's one thing to produce products on the farm. It's another thing to get those to market and get them processing. And the nice thing about this loan program is it can help facilitate that process. So farm programs and then loan programs. If you are in need of capital for starting a farm or making improvements to that farm, like building a building, farm loans are a great opportunity through the Farm Service Agency. And those could be ownership loans, operating loans, microloans. Two types of loans, those that come directly from FSA, and then guaranteed loans that come from a lender like a traditional bank, but they are backed by the FSA. So some good opportunities there. There is some eligibility that goes with farm loan programs, and so it's always good to talk to a loan expert to see if you qualify. I always try to give the advice that you do need to kind of sell yourself and your operation because there's no point in being modest. If you have good farm experience, if you have a good credit rating, if you have a good idea, those are all things that kind of contribute to the application. It still comes down to pencil and paper, but you do need to make sure that the farm loan officer that you're working with has all of the information they need to ensure that you are eligible. These loans, they can be used for equipment, for purchasing livestock, for production expenses like feed. There is a 1 to 7 year repayment schedule, and the limit is $400,000 for operating loans. That's going to be one opportunity, operating loans for the purchase of equipment, livestock, production expenses. There is also farm ownership loans. So if you want to purchase land, the limit is $600,000 for that. And that can be used for land purchases or capital improvements. So there are opportunities there. A lot of times, though, microloans might be the better option. If you are needing $50,000 or less, microloan application is much, much easier. It's much, much shorter, and it's just it's a little bit easier as compared to some of the full-blown loans. So depending on how much capital you need, I would encourage you to look at this microloan option. So I mentioned guaranteed loans. So guaranteed loans are when you work with a lender like a Farm Credit or a local bank, and the FSA is behind those, even though you're working directly with a bank. The nice thing about a guaranteed loan is that it does have a much higher limit. So if you're looking to make a large land purchase, guaranteed loan is going to be the way to go, because it has a little bit more than a $2 million high-end limit. The one that we oftentimes recommend to beginning farmers is the down payment loan. And that is because of the terms and conditions that are with this. It's much more conducive to someone who is just starting. The down payment loan it helps you partially finance the purchase of the family farm. So if it's in your family, this is a good opportunity. A 5% cash down payment. That's why it's called the down payment loan. It's because it has a very low 5% cash down payment. So while this doesn't work for everybody, when it comes to beginning farmers and transitioning a family farm, this is the one that we typically recommend. So that is a very high-level overview of NRCS and Farm Service Agency. I'm going to stop now and kick it over to my counterpart, Erica, for her presentation on the Value-Added Producer Grant.
Awesome. Thank you so much, Will. Hello, everybody, and welcome to my presentation about the Value-Added Producer Grant for livestock producers. This quarter's presentation is geared towards livestock producers, and so we're going to discuss all ways that the VAPG can assist livestock producers. Next slide, please. Okay, so the Value-Added Producer Grant Program helps all agricultural producers enter into value-added related activities, planning, processing, and marketing of new products. The goals of this program are to generate new products, create and expand marketing opportunities, and to increase producer income. Grants are awarded through a national competition. Each fiscal year, applications are requested through a notice published in the Federal Register, and through an announcement posted on grants.gov. Typically, the announcement is made in January or February, and then you have about 3 months to prepare your application and submit it sometime around April or May. Next slide, please. All right, so we're going to discuss who is eligible. The different applicant types for the value-added producer grant are as follows: agricultural producers, agricultural producer groups, farm or rancher cooperatives, and majority-controlled producer-based business ventures. You may receive priority points if you are a beginning farmer rancher, a socially disadvantaged farmer or rancher, a small or medium-sized family farm. That's typically a family farm that makes less than $1 million net or gross. No, it's net each year. So there's actually a lot of small farms here in Oregon that would qualify for that. A farmer or rancher cooperative, cooperatives automatically receive priority points. Or if you are proposing a mid-tier value chain project, which essentially means that you have multiple family farms working in conjunction with one another, and the project is benefiting multiple farm families. Next slide, please. So we're going to go into depth on the different applicant types. So agricultural producers are typically individuals or entities that are just 100% owned and controlled by a farmer or rancher individually. You see a lot of husband-wife duos, parent, parent-son, parent-daughter kind of family structure, but it doesn't have to be. It could just be, an individual that's farming. 51% or more of the raw commodity for the project must be produced and owned by the individual agricultural producer. Next slide. Agricultural producer groups are nonprofit membership organizations that represent agricultural producers and whose mission includes working on behalf of agricultural producers. So at least 50% of the membership and board of directors must be comprised of agricultural producers. And for this applicant type, they're only allowed to apply for emerging market project types or simplified application types. So there's a little bit more work that needs to be done for these application types. Next slide, please. Farmer or rancher cooperatives must be owned and controlled by agricultural producers that are incorporated in the state in which it operates. Pretty straightforward. You need to be formed as a cooperative in the state of Oregon to apply in Oregon. Next slide. Lastly, we have the majority-controlled producer-based business venture. This applicant type is essentially a for-profit business other than a cooperative in which 50% or more of the financial ownership and voting control is held by agricultural producers. So that's just a long-winded way of saying at least 50%, or I guess I should say more than 50%, so 51% of the ownership structure is actual farmers, and then 49% can be passive investors. Okay, so now that we've covered who the applicant types are, we're gonna go into what is considered a value-added product. So there are 5 different categories a qualifying value-added product can fall under. The product only need to qualify under one of these categories to qualify, but they may qualify under more than one. The most common is change in physical state. The second most common is produced in a manner that enhances the value, and then product segregation, which is very similar to produced in a manner. Farm or ranch-based renewable energy, which I would say is probably the least common. And then lastly, the locally produced agricultural food product. So change in physical state represents an irreversible processing activity that alters the raw agricultural commodity and enhances its value. It's something other than just a post-harvest process that primarily acts to preserve the commodity for later sale, but it enhances the value, the price of it. So for example, we have livestock cuts of meat into livestock into cuts of meat, cured or smoked meats, or semi-cooked meat products. We also have seen projects that take livestock fiber and turn them into home goods such as rugs, bags, pillowcases, or just plain fiber. And then you can also take the hides and turn them into leather goods, or even the bones and turn them into broth, or I don't know what else, but you know what I'm saying. You could take the bones and turn them into broth. Produced in a manner that enhances the value of the agricultural commodity refers to the way in which the value-added product is developed. So the use of a recognizably coherent set of agricultural production practices in the growing of the raw agricultural commodity, such that a differentiated market is identified. Typically, we see this in the produce market, but in some livestock examples, we have free-range chickens, grass-fed beef, or organic eggs. Different kind of tag words: free range, grass-fed, organic, those types of markets. Physical product segregation is the physical separating of an agricultural commodity from another variety of the same commodity. And again, this is typically seen in produce, between like GMO, I don't know, tomatoes versus non-GMO, but you could also have GMO fed chickens. And it, like I said, it's very similar to produced in a manner, but this one is under a separate methodology in its product segregation. Next slide, please. This methodology is very specific. It's the farm or ranch-based renewable energy, which it refers basically to the process of generating renewable energy from bio-based crops or waste products on a farm. And this is relevant to livestock because livestock manure turned into methane via an anaerobic digester is pretty much the only, I guess, project that I can see being eligible for this value-added methodology. The other one is taking corn and turning it into ethanol, but that's not really livestock-based. So one thing to note is that on-farm generation of energy from wind and solar, geothermal, or hydro sources are not eligible because it's not a bio-based product. That's just, a natural thing that comes from the earth, and you're not generating anything. Locally, the last methodology is the locally produced agricultural food product, which refers to any food product that is raised, produced, and distributed within a 400-mile radius, and typically has special characteristics that attribute to the area in which it's sold. And I couldn't really find any good examples for livestock. Maybe y'all could help me think of some, but the best example I can give for this is Willamette Valley grapes. They have a very distinct characteristics, and they're marketed as Willamette Valley grapes all over the world. And so they're able to put a premium on their wines because of the geographic location in which it or originates from. Next slide, please. All right, so how may the funds be used? The most common way that they're used is working capital expenses, which may be used to pay eligible processing and marketing expenses of a value-added product. So some examples of this include slaughter fees, transportation from the butcher shop, any packaging, labels, shipping or freight costs, transaction fees, point of sale equipment, vacuum sealers, and then like spices and seasonings if you wanted to make different pepperoni or something, charcuterie meats. Marketing and advertising expenses include like in-person marketing labor, materials, online advertising, website development, and other some merchandise. Merchandise meaning like t-shirts, hats. The kicker on this is that it has to be product specific, not just the name of your family farm. It has to have, if you're selling beef, it has to have a picture of a cow on it. I don't know. It's a silly little requirement. Some raw commodity also may be purchased. It's capped at 49% for the total project. And then salary expenses for processing, some administrative costs, and some other costs in for salary, but sometimes it's hard to determine what expenses might be eligible. And so if you have any specific questions, join me in the breakout room afterwards and we can discuss specific expenses that you have on your mind. The maximum grant amount for this working capital project would be $250,000. And it is a one-to-one match requirement. So when you apply for a full $250,000 grant, you'd have to match $250,000 either in the form of cash or in kind. And we'll go into that a little bit further, what the difference between cash and in kind is. The other way that you can use this grant is for planning activities. And really that is two things: conducting a feasibility study or developing a business plan or marketing plan. And it's up to $75,000. And what you would do is you would pay a qualified consultant to conduct a overarching feasibility study on the project itself. So if you have an idea, you want to increase your sales of beef from what it's at now to double, is that feasible? What are the things that you would need to put in place in order for that to be successful? What markets are in your area? What are the trends? Those kind of things. And we don't have any specific qualified consultants that we can recommend, but we have a partnering agency that has a list of qualified consultants that we can let you pick through and find one that is going to work for your project. Some ineligible use of funds. You cannot purchase land, buildings, or equipment with this. And I have a lot of folks disappointed with the fact that you can't purchase equipment. Trust me, I totally agree. There are some exceptions for equipment, but it has to be run through someone like me or different RD employee to determine whether or not it would be eligible. Preparation of the grant application, you can't include that fee in the grant. So that's not eligible. Anything research and development wise, this doesn't mean feasibility study. Research and development really means if you had an idea for a product that was not typical for the market or not already on the market and you wanted to do research on it in a lab, maybe you're going to look at the fat content of something or you needed specific lab research done, that is not eligible for this project. Architectural or engineering design work. In the feasibility study, you can have them look up things like how much is it going to cost for you to build a processing facility, but you can't have actual plans and specs engineered and written up for you. And then lastly, expenses for raw commodity cultivation or production, harvesting, or delivery to a processing facility. All of those things are considered pre-harvest or agricultural production rather than agricultural processing. So for the VAPG, just a good rule of thumb is to think of it from a post-harvest start line. So everything post-harvest is when the eligible activities begin. Anything pre-harvest, like, seeds, grain, fertilizer, anything that you would need to produce the raw commodity is ineligible for this grant. This is where I want to get into the match requirement. So the VAPG requires a one-to-one match, either in the form of cash or in-kind contributions. Examples of in-kind contributions can be either time spent on processing and or marketing expenses, or the value of the raw commodity contributed to the project. All of the funds, all funds, including matching funds, must be spent on eligible expenses only. And they must be spent in advance of grant funding. So for every dollar of grant funding dispersed, no less than that equal amount of matching funds will have to be expended prior to submitting a request for reimbursement. And unlike wills, we don't do advances in this for this grant unless there's like super extenuating circumstances, and that's on a case-by-case basis. But typically it is a reimbursement-based grant, and the match requirement is needing to be validated prior to award. Awesome. So how do we get started? Applicants must provide a valid SAM registration. SAM stands for the System for Award Management, and this is the website that all federal grant recipients must register in prior to receiving grant funding. And it's good to get started on this process sooner rather than later because it can take some time to go through the different evidence or registration steps. And so let's see, when you begin the process of registering, there are 3 choices of what types of registration you want. And the 2 that you should strive for is financial assistance awards only or all awards. If you do get unique entity ID only, that is not considered a registration in SAM. So that's really important to do one or the other. Financial assistance awards only, which is the most common for RD VAPG recipients, or you could register for all awards. I always recommend to people who are interested in applying for this application, this grant, to reach out to myself. I am the VAPG coordinator for the state of Oregon, and I can help provide guidance and outline the requirements needed to submit a complete and competitive application. Prior to the deadline. I will go back and forth, review drafts, and let you know if there's anything missing so that it doesn't get, accidentally disqualified for something being missing. My preferred method of contact is email, and then when we establish a correspondence on email, we will schedule times for phone conversations so that we can really get in deep on the specifics of your project. So I will put my contact information in the chat for y'all. Awesome. Thank you so much for listening to my presentation. And of course, join the breakout room if you guys have any specific questions about projects that you have in mind. Thank you.
Thanks, Erica. Appreciate it. Our next presenter is with the Risk Management Agency, and I'll kick it over to you, Anna. And you're on mute, Anna.
Yes, sorry about that. You can hear me okay now, right?
Yep, good to go.
Okay, and everyone can see my screen?
Yes, thank you.
Okay, perfect. Okay, yes, so my name is Anastasia Griffin, and I will be discussing the Risk Management Agency and our portion for this livestock event. So just before I really get going with the presentation, I just wanted to mention this disclaimer with everyone. The purpose of the following material is to promote awareness of risk management concepts and to highlight USDA's risk management products, features, benefits, and availability. This material does not change the content or the meaning of current policy provisions, filed actuarial documents, or approved procedures. Okay. Now, again, I am from the Risk Management Agency's Spokane Regional Office, and we administer the federal crop insurance programs in Alaska, Idaho, Oregon, and Washington. We also provide outreach to help farmers with risk management tools. RMA's vision is to secure the future of agriculture by providing world-class risk management tools to rural America. RMA is responsible for developing and maintaining federal crop insurance policies. This includes determining the rates, prices, and yields for each crop at the county level every year. RMA is also in charge of compliance to prevent fraud or abuse. Private insurance companies and agents are responsible for selling insurance policies to farmers and settling their claims. The federal government subsidizes the premiums to reduce the cost of crop insurance for farmers and reinsures the private insurance companies to share the cost of the claims. Federal crop insurance provides protection from production loss, price decline, or a combination of both for individual commodities. There are production and revenue plans of insurance, which are based on a farmer's actual production history. Area plans of insurance that are based on averages in an area, such as by county, and the Farm Service Agency also has a non-insured crop disaster assistance program called NAP that is available in counties where RMA crop insurance is not available for a particular crop. This provides financial assistance to producers of non-insurable crops to protect against natural disasters that may result in lower yields or crop losses or prevented crop planting. So why should you consider getting federal crop insurance for your farm or ranch? Well, it may help you stay in business after a bad weather event or a low production year. The government subsidizes the premium to make it more affordable. It also provides some financial stability, and it may improve your access to credit. There are 4 phases of the crop insurance cycle each year. And again, this is for the majority of our crop insurance plans. I will be going over in just a second our livestock plans, which will be a bit different than this. So for most of our programs, there are 4 phases of the crop insurance cycle each year. The insurance plan, level of coverage, and price are selected when you submit an application. It is very important to know the sales closing and cancellation dates. These are the deadlines for buying or canceling your policy. There's also a date for reporting how many acres of the crops you plant to determine your premium. You have to provide a notice of loss to start the claim process, and RMA may make program changes prior to the next year's contract change date. So with that being said, we do have specific livestock programs that I'm going to be going over. We have three particular programs that are designed for livestock. The first one is for dairy. So I'm just going to go over this really quickly. The Dairy Revenue Program, or Dairy Revenue Protection Program. It is available in all counties in all states, and the covered milk production is indexed to the state or region where the dairy producer is located. So you may cover 80 to 95% of your expected quarterly revenue in 5% increments. A premium subsidy is available and based on the coverage level you select. Coverage is established by adding quarterly coverage endorsements to your policy. The sales period begins each day when the coverage prices and rates are validated and published on RMA's website by 4:30 p.m. Central Time and ends at 9 a.m. Central Time of the following business day, in which you can purchase quarterly endorsements. Dairy revenue protection will not be sold on days where the monthly USDA milk production, dairy products, and cold storage reports are released. Milk or dairy commodity prices that experience a limit up or down move in the futures market will not be available for determining the quarterly expected revenue. The quarterly coverage endorsement corresponds to the 8 quarterly insurance periods available for purchase during the crop year. Producers may purchase coverage up to 5 nearby quarters and have multiple endorsements for the same quarterly insurance period. And then additionally, I just wanted to mention here that for the Dairy Revenue Protection Plan, the causes of loss for the insurance is only for the difference between the final revenue guarantee and the actual milk revenue, times the actual share and protection factor caused by natural occurrences in market prices or yields in the pooled production region. It does not insure against the death of dairy cattle, other loss or destruction of your dairy cattle, or any other loss or damage of any kind whatsoever. So that was the first livestock or livestock adjacent program that I wanted to mention. The next one I want to talk about is the livestock gross margin. And this is divided up into 3 different programs. The first one is cattle. We also have dairy, and then we have swine. So we call it LGM, and it does protect against the loss of gross margin, which is the market value of the livestock minus feeder cattle and feed costs. So a premium subsidy is available for those policies that insure multiple months during the insurance period. You can sign up for LGM cattle each week and insure all of the production that you expect to market over a rolling 11-month insurance period. LGM cattle is sold on the Thursday of the week when the coverage prices and rates are posted on the RMA website, and it ends at 9 a.m. Central on the following day. Your premium payment is due at the end of the insurance period. If expected gross margins and feed prices are not available, or if there's a federal holiday on that day, LGM cattle will not be offered for sale for the insurance period. And just to let everyone know, the prices are based on the simple averages of the Chicago Mercantile Exchange Group futures contract daily settlement prices and are not based on the prices you may receive at your market. Okay. Now, sorry, I got confused on my slides here. Okay. So the next one for LGM is for dairy cattle. So again, this is going to be very similar, but it's specifically regarding dairy cattle as opposed to the regular LGM cattle program. So the LGM dairy cattle uses the futures price for corn, soybean meal, and milk to determine the expected gross margin and the actual gross margin. It is similar to buying both a call option to limit higher feed costs and a put option to set a floor on milk prices. So that is a little bit about the LGM for cattle. we do have a program for LGM swine. So again, this is going to be similar to the LGM cattle. So you are able to purchase this. We do have operations that are covered by LGM swine, such as farrow to finish operations, feeder pig to finishing operations, and segregated early weaned operations. The premium is due at the end of the coverage period, and LGM premiums are dependent on your marketing plan, the coverage that you choose, the deduction, the deductible level, and the futures and price volatility. So that's a little bit about the livestock gross margin programs. The other livestock program that I wanted to mention to everyone is our livestock risk, and I misspelled that. It's supposed to be risk. It's not risk protection, it's risk protection. So that's livestock risk protection, or LRP. And then again, we have that for both fed cattle, feeder cattle, and for swine. So regarding fed cattle, you can purchase specific coverage endorsements up to 12,000 head of heifers and steers, weighing between 1,000 and 1,600 pounds, that will be marketed for slaughter near the end of the insurance period. And then you have different lengths of insurance coverage that are available for each specific endorsement. And then we also do have an annual limit for the LRP fed cattle per producer for each crop year. And again, this is designed to insure against declining market prices. So beef producers can choose from a variety of coverage levels and insurance periods that would correspond with the time the market weight cattle would normally be sold. And this, along with all of our programs, are available through approved livestock insurance agents. So again, this is part of the public-private partnership that all of the policies will be sold by approved agents. And then for premium rates, coverage rates, and actual ending values, those are posted online daily on the website. You can also choose for LRP between coverage prices ranging from 70 to 100% of the expected ending value. And at the end of the insurance period, if the actual ending value is below the coverage price, you may receive an indemnity payment for the difference between the coverage price and the actual ending value. And then for the LRP, the LRP for feeder cattle, the livestock risk protection for feeder cattle, we have that again. This is available in all counties, in all states. It's designed to insure against declining market prices. You can, again, choose from a variety of coverage levels and periods that match up to the time that you would normally market your cattle. Again, you can choose between the different coverage levels through an approved livestock agent. And the actual ending values are based on the weighted average prices, also from the Chicago Mercantile Exchange Group Feeder Cattle Index. The actual ending values are posted on RMA's website at the end of the insurance period. And so you have coverage that are available for calves, steers, heifers, Brahman cattle, dairy cattle, and unborn calves. And you can choose between the two weight ranges for the feeder cattle, between 100 and 599 pounds, and then between 600 and 1,000 pounds for feeder cattle. The last program that I wanted to talk about is for the livestock risk protection swine. So again, this is going to be very similar to the one for cattle, but this one, you can purchase specific coverage endorsements for up to 70,000 hogs that are expected to reach market weight near the end of the insurance period. And then we do have also an annual limit of 750,000 hogs per producer for each crop year. And in addition, you can choose between that 70 to 100% of the expected ending value for your coverage. And then also visit RMA's website to see the LRP swine programs coverage prices, the rates, actual ending values, and per hundredweight insurance cost. So the actual ending values will be calculated from price series data from USDA's Agricultural Marketing Service, or AMS. The actual ending values are posted on our website at the end of the insurance period. And I know I'm running through this a little bit quickly, but I just wanted to mention a few other things. This is the RMA's website. So I have on here on the left-hand side, we've got our website, which is rma.usda.gov. We have the information that is available for finding an insurance agent. If you'll see there circled in red, I have the agent locator that is on our website. You can just type in your location or your zip code. And then if you are a livestock producer, you can indicate that on our agent locator, or if you are growing something else, indicate that as well on the agent locator. We also have different languages that are available that you can indicate there as well. We do have other programs available, such as the row crop programs, such as wheat or barley. We have the whole farm revenue protection program that will insure all of the crops on your farm. So we've just got a lot of information on our website. If you want to get more information, there is that section circled in yellow, and it says Get Started, and that's specifically for beginning farmers and ranchers. And then one last thing I wanted to mention here is we have general RMA beginning farmer rancher benefits. So we do have, for beginning farmers, additional premium subsidies and subsidy premium, where we subsidize the premiums for the beginning farmers and ranchers, and the exemption from the administrative fee for the catastrophic policies. So we have a few other benefits there you can see on the screen. And by all means, if anyone has any questions, I am available in our breakout session room. And you can also email me. I'll put all of my contact information there in the chat. You can also call this number here on the screen. We are located in Spokane, but we do cover not only Oregon, but we also cover Idaho, Washington, and Alaska in addition to that. So with that being said, I think I am actually done for this. I know I kind of ran through it a little bit quickly, but we had a lot of information here for livestock, so I hope that was okay. And if you have any questions, just please, by all means, just let me know. Thank you.
Thanks very much, Anna. In our last couple of minutes, I'd like to pitch it over to the National Ag Statistics Service and Mr. Dave Losh to introduce his organization as a fellow USDA employee.
Well, good morning, everyone. Thanks for being here today. I am Dave Losh. I work as a state statistician for USDA's National Agriculture Statistics Service, and our agency provides the stats on what everybody does in agriculture. We share that data in a published format to everybody on an equal basis. And it helps support the programs you just heard about as far as the NRCS and FSA. When folks back in DC and lawmakers are considering funding programs, they want some numbers to see what it's going to cost and what the benefits are for people. And they use our numbers to help do that. So we conduct surveys throughout the year, depending on what you're producing. For livestock, we primarily have two primary surveys, one in July, and then the other, the big one, around January 1st for livestock producers. And so we will put estimates out as to number of head being raised and some other information. And you can use our data to go out and look if you are thinking about raising a product to see if there are other producers in your area or what types of livestock are there. So that might be helpful if you have an idea as well, to know that maybe there's some support. Maybe there's going to be some services already there as far as other businesses or even for mentoring opportunities with other producers if you're beginning. All of our surveys, annual surveys, are voluntary. They're not required by law. We do have a strict confidentiality policy that we do not share any of the raw data with any other USDA agencies, not with the IRS, no one. We are subpoena free, we're FOIA free. Nobody can get access to your individual data. It's protected by federal law. We do publish some data from the U.S. Census of Agriculture that's done every 5 years down to the county level. So that may be helpful too. Maybe you're wanting to see if there, if you're going to raise some livestock, if there's feed raised or there's pasture out there, maybe. So that could be a good source of information for you. If you're beginning and you're not in our receiving surveys from us for what you're producing, you can sign up at that's agcounts.usda.gov. And you can reach me regarding anything what's out there in statistics at dave.losh@usda.gov, and I'll put my contact information in on the chat.
All right. Thanks very much, Dave. I appreciate you joining us.
Thank you.
That wraps up our presentation for today. I'm going to open the breakout room so that if you have questions, you can choose which room to go into, and you can switch rooms. There should be an option on your Zoom screen to enter a breakout room and even switch between breakout rooms. But I'm going to go ahead and open up those rooms and stop the recording. So thank you all very much for joining us today. And again, this recording will be posted on YouTube. Please join whichever room you would like.